Welcome back to Gold Rush Reporter, your go-to channel for the latest insights on gold and silver. I'm your analyst, breaking down the complex world of precious metals into simple, actionable updates. Today, we're diving into a topic that confuses a lot of people. Why are precious metals subject to taxes? You might think buying gold or silver is straightforward, but the tax rules make it a bit tricky. Stick with me, because understanding this can save you headaches and money. First off, if you buy gold or silver using a check, wire transfer, or electronic payment, there's usually no immediate reporting or tax requirement. The IRS isn't knocking on your door for transactions under $10,000. However, if you buy more than $10,000 in cash, you'll trigger Form 8300, which reports your purchase. That's not just for gold. It applies to any large cash transaction in the US. They'll want details like your social security number, the exact bills used, and denominations. This is meant to prevent money laundering, but it often confuses investors. Now let's talk about selling. There are 4 main triggers for dealer reporting when it comes to gold. If you sell gold bars over 32.15 ounces, 1 kilogram, the dealer must file a Form 1099-B. This form reports your social security number and the sale. Coins like Mexican 50 pesos, Krugerrands, or maple leafs have different rules. Selling less than 25 ounces at a time doesn't require reporting. You can technically split your sales into multiple smaller transactions, as long as they are unrelated. But be careful, breaking the rules intentionally can land you in trouble. For silver, the rules differ slightly. Selling more than 1,000 ounces of silver bars or rounds triggers a 1099-B. Junk silver, like pre-1965 dimes, quarters, and half dollars totaling over $1,000, also triggers reporting. The IRS tracks all these transactions closely, but it's ultimately your responsibility to report profits correctly. Dealers may report, but if they don't, it's still on you to handle taxes properly. The key takeaway? Buying silver does not usually trigger taxes, but selling significant quantities of gold or silver does. This is why keeping good records matters. Even if you've been buying metals consistently for decades, estimating your costs when selling may be required. The IRS expects you to provide your best guess if records aren't available, so stay organized. On top of taxes, there's another trend you need to watch. States approving gold and silver as legal tender. Missouri and Wyoming recently allowed these metals for public and private obligations, including use in state reserves. Kansas and Tennessee are considering similar measures, and Idaho and other states are taking steps to hold gold as part of public pension funds. This movement shows a growing awareness that traditional fiat money can be risky, and tangible assets like gold and silver provide a hedge. So stay tuned. Understanding these rules isn't just academic. It directly impacts your strategy as a precious metals investor. Keep your transactions below reporting thresholds when possible, know your responsibilities for larger sales, and watch state initiatives that make gold and silver even more important in the economy. Let's continue breaking down what's happening with precious metals in the US and globally. Several states are now recognizing gold and silver as legal tender. Missouri and Wyoming have passed laws allowing gold and silver to be used for all public and private obligations, including taxes and state reserves. Kansas and Tennessee are considering similar actions, and Idaho has already enabled state pension systems to hold a portion of physical gold. Other states, Texas, Ohio, West Virginia, Mississippi, Maine, Tennessee, and Montana, allow up to 5% of public pension funds to be held in gold. This shows a growing awareness that fiat currency can be unstable. By including gold and silver in state reserves, governments are hedging against inflation and the dollar's devaluation. For investors, it's a strong signal that tangible assets remain critical for long-term wealth preservation. Globally, central banks are acting decisively. Hungary recently repatriated gold from foreign storage, signaling confidence in holding physical assets. During this period, hundreds of military officials who supported NATO were dismissed, illustrating the geopolitical dimensions of gold accumulation. Turkey's massive gold purchases in 2022 followed the same trend. Countries outside the Western financial system are moving reserves into precious metals to reduce dollar exposure. China and Kazakhstan are also accumulating metals aggressively. Both, along with the Eurasian Economic Union and Shanghai Cooperation Organization members, are strengthening economic ties while stockpiling gold, silver, and rare earths. These nations act strategically, and central bank purchases like these can influence prices dramatically. Meanwhile, the US faces growing pressure on its financial system. Pension funds are underfunded by 1.75 trillion. National debt is climbing, and massive foreign aid and spending further strain the dollar. High inflation, combined with Fed policies, makes physical metals attractive. Central banks worldwide increasingly see gold and silver as strategic assets, not just investment vehicles. Energy and rare earth metals add another layer. Saudi Arabia, China, and Qatar are finalizing multi-billion-dollar energy contracts outside the dollar system. Nations controlling rare earth elements, key for batteries, EVs, and advanced tech, are managing supply strategically. These factors indirectly boost the value of gold and silver, as countries hedge against currency risk and secure tangible assets. All these movements indicate a coordinated shift toward hard assets in an era of fiat instability. For stackers, physical metals are more relevant than ever. Prices are likely to move higher as central banks and governments continue building strategic reserves. The trends in US states, along with global central bank activity, show that tangible assets are becoming increasingly essential. Looking at the BRICS nations, there are some subtle but significant developments impacting precious metals. While the US dollar remains dominant, nations like China, Russia, and now Hungary are quietly shifting their reserves into gold. Hungary's recent gold repatriation and the firing of NATO-aligned military officials suggest that political alignment and financial strategy are deeply intertwined. Turkey's previous record-breaking gold purchases fit the same pattern, preparing for financial independence from Western monetary systems. Central banks in the BRICS countries are acting as early movers. China and Kazakhstan were the second and third largest buyers of gold in January, following a trend of aggressive accumulation that aligns with their long-term strategies. These purchases are not random. They are positioning these nations to protect against potential US monetary policies that could affect their reserves, like unexpected rate cuts, inflation, or dollar devaluation. This trend is tied closely to global energy markets. Saudi Arabia's decision to stop using the dollar as a settlement currency, combined with China's multi-billion-dollar natural gas deal with Qatar, demonstrates a deliberate move away from reliance on the dollar. By trading energy in other currencies or directly through precious metals, these nations reduce exposure to US-controlled financial mechanisms. This indirectly strengthens gold and silver as alternative reserve assets. Rare earth metals are another critical factor. Countries in Eurasia control the majority of the resources needed for batteries, electric vehicles, and other high-tech applications. Iran's claim of discovering one of the world's largest lithium deposits highlights the increasing competition for strategic materials. Nations outside the dollar system are ensuring access to these resources, which further incentivizes holding metals like gold and silver as hedges against supply disruptions and currency risk. Back in the US, states recognizing gold and silver as legal tender are effectively creating microeconomic hedges, allowing public pension funds to hold physical metals or enabling tax payments in gold and silver introduces alternative monetary mechanisms that could gain traction if inflation continues or if fiat currencies lose purchasing power. Idaho's recent moves are likely a model for other states that aim to protect their citizens from economic instability. This dual action, global central banks stacking gold and silver and US states enabling legal tender policies creates a structural push toward hard assets. Prices for physical metals may respond quickly once investors recognize the broader macroeconomic and geopolitical trends. It is not merely speculation. It is a response to rising inflation, geopolitical uncertainty, and strategic resource control. For stackers, understanding this context is critical. Silver and gold are no longer just commodities, they are strategic tools. Tracking central bank purchases, BRICS developments, and US state policies provides insight into potential price movements. Metals like silver are approaching nominal highs, while gold is showing consolidation in bullish patterns. The convergence of these factors points to continued upside potential for those holding physical assets. Shifting focus to US tax regulations, this is where many investors get tripped up. Buying precious metals like silver or gold is generally straightforward, but selling them can trigger reporting requirements that are often misunderstood. For instance, purchases under $10,000 in cash usually do not require Form 8300 reporting. This means if you're paying with a check, wire transfer, or electronic funds, your transaction isn't automatically reported. Cash payments above that threshold trigger reporting, but the IRS only wants the standard details: name, SSN, and denominations used. For selling, the situation becomes more nuanced. Gold bars over 32.15 ounces, or 1 kilogram, require the dealer to file a Form 1099-B, reporting the sale as miscellaneous income. The same applies to junk silver with face values exceeding $1,000, as well as sovereign coins like Krugerrands, maple leafs, and 50 pesos when sold in large quantities. This isn't an arbitrary rule. It's part of an agreement between the IRS and the industry via the Council for Tangible Assets. However, the key point here is that the buyer's responsibility doesn't end with the dealer reporting. Even if a transaction doesn't trigger a Form 1099-B, the investor must track purchases and sales to report capital gains accurately. For example, if you bought silver over the last 20 years without keeping receipts, you may need to provide your best estimate of purchase prices when filing taxes. The IRS understands this challenge and allows reasonable approximations, but it emphasizes maintaining records to substantiate claims. Some investors worry about structuring transactions to avoid reporting. While technically, multiple smaller transactions under reporting thresholds can be legal, trying to circumvent the system deliberately is risky and could trigger penalties. The safest approach is transparency and documentation. Track every purchase, keep records of amounts spent, and ensure that when selling, gains are properly reported to avoid legal complications. State-level developments add another layer to this story. Missouri, Wyoming, Idaho, and Kansas have started recognizing gold and silver as legal tender. This means taxes, debts, and even state-held assets can include precious metals. Some states allow public pension funds to allocate up to 5% of assets into physical gold, reflecting a growing recognition of metals as not just commodities, but as secure hedges against inflation and fiat currency risks. These policies are particularly relevant given the Fed's monetary interventions and the devaluation pressures on the dollar. Globally, central banks continue to increase gold and silver holdings. BRICS countries and other nations are diversifying reserves, hedging against dollar risk, and securing resources like rare earth metals for strategic industries. These moves reinforce the long-term importance of precious metals as both monetary and geopolitical tools. US investors can't ignore these trends. Stacking physical metals isn't just about price speculation. It's a hedge against macroeconomic and geopolitical instability. Wrapping up everything we've discussed, let's bring clarity to the big picture. Precious metals are not just investment vehicles. They are strategic assets that can protect wealth against currency devaluation, inflation, and geopolitical uncertainty. Understanding the tax landscape is crucial. Buying gold or silver using electronic transfers avoids reporting, while cash purchases over $10,000 trigger Form 8300. Selling large quantities, over 32.15 ounces in bars or over $1,000 in junk silver, requires filing Form 1099-B, but the ultimate responsibility to report gains always rests on the investor. Keeping meticulous records is not optional, it's essential. States like Missouri, Wyoming, Idaho, and Kansas are paving the way for precious metals to be recognized as legal tender. Some public pension systems can now hold up to 5% in physical gold, reflecting a shift in how government entities view these assets. The trend is clear. Both domestic and global players are stacking precious metals to hedge against the instability of fiat currencies. The BRICS nations, along with other countries, continue to acquire gold and silver, repatriate reserves, and secure rare earth metals, further underscoring the strategic value of these commodities. For US investors, the takeaway is simple. Knowledge and timing are critical. Monitor the markets, follow central bank actions, and stay updated on state-level policies that could affect how gold and silver can be held or used. Diversifying between physical bullion, coins, and ETFs can offer flexibility, but physical assets remain the ultimate hedge in times of economic uncertainty. Remember, these metals are not just investments. They are insurance against the erosion of purchasing power and global financial turbulence. Actionable strategies for stackers. First, maintain detailed purchase records and track cost bases carefully. Second, diversify holdings between physical metals and secure ETFs to balance liquidity and long-term safety. Third, stay alert to geopolitical developments and central bank activity, as these factors heavily influence metals' price trajectories. Fourth, understand and comply with all tax obligations to avoid surprises, ensuring that gains and transactions are reported accurately. Finally, stackers, remember that gold and silver are tools for long-term financial security. The market is heating up, both domestically and internationally, and opportunities for strategic acquisition are growing. Don't wait for the headlines. Act while you have knowledge and foresight. Protect your wealth and keep stacking safely. If you found this breakdown insightful, actionable, or simply thought-provoking, make sure to like, comment, and subscribe to Gold Rush Reporter. Your engagement helps us bring more in-depth analysis on gold, silver, and the latest market developments straight to your screen. Share your thoughts and stacking strategies in the comments. I always read them and respond when possible. Until next time, stackers, stay informed, stay strategic, and most importantly, stack safely. I am your gold and silver analyst here at Gold Rush Reporter, bringing clarity to precious metals for every investor serious about protecting and growing their wealth.